International investors have all eyes on Greece right now, where the country's financial crisis has hit a peak. How did Greece get to the brink of collapse? Their current crisis began in 2001 when Greece adopted the euro as its currency. In the aftermath of the 2008 global financial crisis, Greece had increasing difficulty servicing its very heavy sovereign and private debt. In 2010 and again in 2012, 3 European and international lenders stepped in and provided the country with a total of 270 billion euros in bailouts. But the aid plan had some stipulations. As part of the deal, Greece was required to cut public sector spending, run a budget surplus, and lay off government workers. In the wake of the bailouts, Greece's unemployment rate rose to 28% in 2013, and the country fell into a deep depression. Greek politicians seeking office ran on reversing these austerity measures. And in January, the far-left Syriza party was elected into power after vowing to do just that. Now, the government has announced it intends to default on a nearly $1.8 billion payment to the IMF. The government also announced it will hold a referendum next Sunday, when Greek citizens will vote to determine whether the country will either continue following the austerity measures imposed by the 3 creditors, or move to reissue its old currency, the drachma, effectively separating Greece from the Eurozone.
If the European Central Bank prints hundreds of millions or hundreds of billions more euros to pay off debts and keep the contagion of the Greece crisis from spreading to Italy, Spain, Portugal, and other European Union countries, that would have an impact on the U.S. because that would mean that the dollar would get stronger because the euro would get weaker since there'd be so many more euros in circulation.